Good evening, ladies and gentlemen. Speaker for the evening, Shri Dilip V Lakhani, Vice President, Mr. Naushad Panjwani, Kirit Dedia, past presidents of the society, Narang Sahab, Pranay Bhai, seniors and friends. It gives me great pleasure to welcome each one of you to this lecture meeting on the subject Limited Liability Partnership, Tax, Accounting and FEMA Issues by past president of the society, Shri Dilip V Lakhani. Friends, number 12 is important to many religions, mainly Judaism, Christianity and Islam. In calendar system, we have 12 months. In astrology, according to the West, zodiac has 12 signs. And back on our computer keyboard, there are 12 functions. I was not aware till today. Okay, there are a lot of significance for number 12. And today is 12-12-12, a unique date, and is considered by some as an auspicious day. Coincidentally, even Dilip Bhai has proposed to cover 12 points today. It is said that when acronym LLP is attached to the company name, you don't have to worry, as it implies lifelong and prosper. So in next 1.5 hours, you listen, learn and progress in coming years and have a nice memory of this day. LLP as a business model first emerged in USA in early 90s. With the passage of time, LLP gained popularity and was adopted and accepted as a business structure in many countries across the globe. Indian legislature, keeping in view the international business trends where a range of services is being offered by professionals and businesses in the form of LLP, enacted Limited Liability Partnership Act 2008, recognizing the changing needs of business in today's times. The endeavor was with an intention to create a facilitating environment for entrepreneurs, service providers, and professionals to meet the global competition, and also that LLP will provide a helpful new option for professional partnerships which are anxious and cautious too about their exposure to liability. Considering the growth of Indian service industry in recent past, it was believed that LLPs would further contribute to the growth of service industry. LLP structure provides the advantage of limited liability to the partners with more credibility as compared to the erstwhile partnership firms. And over the corporate structures, LLP have the benefit of lesser compliances. Whilst there was an initial trickle of mostly large partnerships moving to LLP status, many considering converting but could not identify a conclusive reason for doing so. And some believe that LLP has not provided much needed flexibility, especially to small and medium-sized enterprises. Also, there are various issues that are still bothering many. And couple of issues which I would like to highlight is whether under LLP Act, under Section 23, asset brought in by the partner has to be booked at market value or it can be at cost as per Section 45(3) of IT Act. Another issue that in the absence of specific provision for conversion of firm into LLP, whether decision of Bombay High Court in case of taxpin engineering holding that 45(1) and 45(4) are not applicable in case of conversion of firm to company under Part 9 will also hold good on conversion to LLP. In spite of many such issues, it is now believed that limited liability partnership is an emerging concept in India. Thus, choosing the right vehicle for one's business at the right time is a critical decision as each vehicle will have pros and cons. So today's topic has been chosen with an idea to cover various issues and developments in this field which would give confidence and insight to understand various nuances of the LLP Act vis-a-vis Income Tax Act and issues under FEMA and accounting. Friends, to cover such a wide spectrum, you need vast experience and all-round expertise and an eye for detailing. And that's the quality of our today's speaker, Shri Dilip V Lakhani. Dilip V Lakhani, rank holder in CA Finals, is a senior partner of Messrs. Lakhani and Company, Mumbai-based firm of chartered accountants, practicing in the field of taxation, international taxation, mergers, acquisition, restructuring and FEMA. He was president of Bombay Chartered Accountants Society in the year 1984-85. He has authored several publications, to name a few: Tax Audit Manual, New Assessment Procedures, Investment and Loans under Companies Act, VDI Scheme 1997, Kar Vivad Samadhan Scheme 1998, Mergers, Acquisitions and Intangibles. He has delivered lectures and presented several papers all across the country at various forums on various subjects. His other achievement includes India-ranked international table tennis player. Friends, I welcome Dilip V on behalf of all of you, and as a gesture of respect and appreciation, would request Mr. Naushad Panjwani to offer him a memento. Dilip V.
Mr. President, Honorable past presidents, respected seniors, dear members of Bombay Chartered Accountants Society, it gives me a great pleasure to participate in today's lecture meeting organized by the Society on the subject of LLP. As President said, today is 12/12/2012, a unique day. Generally, with the passage of time, the speaker forgets the date or the subject on which he has spoken. But as far as I am concerned, my last lecture on this very platform and today's date, both this date will be unforgettable during my lifetime. The last lecture was on 26 November 2008. And that was on the subject of survey, tax accounting and legal issues. After we parted from here happily, and all the sad news, all of us heard about it. Today is again 12/12. This is a unique day. I thank the President for fixing the talk on this particular day so that in my lifetime these two events will go as unforgettable days and which will increase my bond with this society which started 40 years ago. I distinctly remember in 1972 June I was inducted into the managing committee of this Bombay Chartered Accountants Society. Coming to the subject of LLP, this LLP is 3 years and 9 months old. It's a child according to me. Unfortunately, we do not have enough material on this subject. There are no case laws, there are no precedents, there is no commentary, enough commentary I would say. The administration of this particular law was by the Delhi ROC in the initial period. When we started dealing with them, they were literally grappling, they were baffled, they were confused how to interpret some of the issues which have arisen during the course in interpreting LLP and registration. Now at least we have a little sigh of relief that it has been decentralized and each ROC has been given power to register an LLP. I personally believe that over a period of time, this LLP will gain importance. More and more businesses will be conducted under this particular structure. And I see also a great opportunity for the professional of our profession. And I sincerely request the younger members to concentrate on this particular subject. And because I assume there will be a good opportunity in future. Apart from this, there is one more area. If you look at the winding up and dissolution rules LLP 2012, they have incorporated a definition of a liquidator. And in that definition, they have provided that the chartered accountants also can be, like company secretary and cost accountants, also can act as a liquidator in case of a company which will be wound up. I feel this is also be a great opportunity for the chartered accountants to practice in this particular area. Before I comment my technical aspect, dealing with the technical aspects, I would request the President that during the course of our discussion, there will be many issues which need further clarification, which we need an appeal to the government to amend the provisions. And if the President and the Managing Committee thinks fit, the appropriate representation should be made to the appropriate authorities so that this is the right time because the budget is down the corner. And if they incorporate some of these provisions in the amendments, then definitely it will help in a smooth functioning of the LLP. President mentioned today is 12/12/2012, and intentionally I chose 12 topics so that I thought that let me see whether I could match with today's date. Though today There are controversy regarding 12/12/2010 is an auspicious day or not an auspicious day. But I do not know whether our 12 subjects will be great useful to all the participants who are present here. In order to have a completeness, I have dealt with some of the procedural aspects also, but depending upon the time, we will just see what are important events and what subjects which we will deal with it. The first is the topic I would like to deal with. Those are the basic features of the LLP. The basic features of the LLPs are that it is an alternate corporate business form which combines the benefit of limited liability and flexibility of the partnership, grants the status of a corporate body and its existence is perpetual. It can hold movable and immovable property in its own name. We had two structures, that is a corporate body and a partnership. Both had their own features, flexibility and limited liability. And this is one, LLP is one entity which has a combination of both. So we are able to have the flexibility of the partnership at the same time having the limited liability on the partnership. When I say that they will be able to hold properties in its own name, under Indian Partnership Act 1932, the partnership is not technically a legal entity. The partnership cannot hold properties. Partnership cannot be, no immovable property technically can be registered in the name of the partnership. Even I understand the demat account also has not been opened in the name of the partnership firm, and rightly so. Because though in income tax we have an entity as a partnership, but as far as the general law is concerned, the partnership is not a legal entity and hence you cannot hold immovable properties. Whereas in the case of LLP, which is equal to a corporate body, so it can hold properties in its own name irrespective of change in the partnership. In a partnership, we are finding difficulty because the immovable properties were registered in the name of some of the partners or all the partners of the partnership firm. And if that partner retires, then in the land records, we are finding great difficulty in making the amendments into those records. Now all those difficulties will go away, because now LLP being given a status of a corporate body equal to a company minus the or plus the benefit of the flexibility of the partnership is what is the status of the LLP. It's a separate legal entity having its own assets and liabilities, and assets and liabilities of the LLP can be appropriated fully towards the liability, and the liabilities of the partners is limited to the extent the contribution made. Irrespective of the act of any of the partners, independently, knowing, unknowingly, if a liability is created on LLP, the partners are liable only to the extent of their contribution. The reason being that one partner of an LLP cannot act as an agent of another partner, whereas under Indian Partnership Act, the partner acts as an agent of the firm as well as he acts as an agent of another partner. And this limited liability concept, why it is accepted is that the LLP agreement which you register with the authorities is subject to public availability and inspection. So even if somebody wants to deal with an LLP, he can go through the document and see what are the powers of the person with whom he is dealing, whether he has an authority to deal with that particular subject or not. Like Companies Act, you can check the records of the company. Similarly, in LLP also, you will be in a position to run through that LLP agreement and see what are the rights and obligations of the partner. Just to complete the subject, it was first presented in Rajya Sabha. Usually it was presented in Lok Sabha, but this was presented in Rajya Sabha, then in Lok Sabha, then President signed on a particular date, officially gazetted. LLP Act came into force from April 2009. The rules came from 1st April 2009, and thereafter we have amendment in LLP Act over the period of last 3 years. If you look at the international presence, President made a little mention about it. Now, if you see even in US, the beginning was in the year 1992. So it is not that it was that far. In 1992, in USA, the first LLP Act was formed. As you all are aware, USA consists of various states. Each state had its own law for the purpose of LLP. but in 1996, they incorporated a Uniform Partnership Act 1996, and most of the states of USA tried to follow the concept and the model which was there in this particular partnership. That's why today also in USA, the status of an LLP is that of a partnership and not a corporate body. In UK, the 2000, the LLP came into existence. Singapore, 2005, it came into existence. We in India, in 2009, we followed a UK and a Singapore structure, because in India, LLP is treated as a corporate body and not as a partnership. When we come to taxation, yes, it is equal to a partnership, but mind you, the legal status and the structure of an LLP is that of a corporate body and not of a partnership. This is most important to bear in mind, the distinction of LLP qua general law, qua Contract Act, qua Transfer of Property Act, vis-a-vis Income Tax Act. And Income Tax Act, why they did it, we'll deal with it when we deal with the taxation aspect of it. What are the activities LLP can carry on? LLP can carry on the activities of any business or a profession. It cannot carry on non-profit activities. And as far as the third aspect which I have touched upon is regarding the NBFC activity, that is the business of trading in securities and business of lending. LLP Act does not prohibit carrying on these activities, but unfortunately RBI and the company law board has taken a view that we will not register a LLP whose main object is that equal to an NBFC. What they are saying is that LLP cannot carry on the business of NBFC. When we made a representation, when I personally met ROC, I met RBI officials and said that we are ready to satisfy all the conditions which you want to put in. You specify the conditions, say issue a circular that you should have a minimum net worth of 2 crore rupees, net on funds of 2 crore rupees, we don't mind, net worth of 2 crore rupees, we don't mind. But they are refusing to register a company or an LLP whose main object is to carry on the business of NBFC. I sincerely request the President to take up this matter absolutely on an urgent footing. We do not mind if they have any objection, but they should come out with the rules or the restrictions, and anybody who wants to cope up with that will fulfill that and carry on the business. Then the issue arises is that, does it mean that NBFC will never be able to make investments? My personal view is that no, answer is no. NBFC is carrying on any other business activity as the primary and a main object. If has the funds available with it, and if they make the investments, then probably an issue will not arise. If you read section 45(1)(a) of RBI Act, which defines what is a business which will fall within the definition of the non-bank, which will make the company eligible to be registered as non-banking finance company. And that circular that section says that any business of carrying on in purchase and sale of securities or of lending. So it should be a business, and a business definition, all of us are very familiar, is there should be a continuity of that particular activity, there should be volume, there should be transactions, the intention of profit motive from that particular activity are the basic test of a business which can be incorporated. Look at the balance sheet of one or two companies I'll mention who are cash rich, Hero Honda, Bajaj Auto. What, don't their companies have any investments into the shares and the mutual funds? Yes, they do have. They all are investing their surplus money into various securities all throughout the year, and they are having a huge dividend and income from the mutual fund units as well. But how are they doing? Are they registered as NBFC? Answer is no. Because they are in a position to take the benefit of the circular issued by RBI. This circular is dated 19th October 2006 and the circular number 158. What does this circular say? This circular says that at the end of each year, you please verify what is the status of the company. And it says that, for the benefit I'll read, the company will be treated as non-banking finance company if its financial assets are more than 50% of the total assets, and their income from financial asset is more than 50% of the total income. You apply this test even to LLP according to me, and at the end of the year, if you are in a position to prove that both these cumulative conditions are not satisfied, then you are not an NBFC, and you are not an NBFC carrying on NBFC activity, then probably you will be able to argue before the authorities that I should be permitted to register a company whose main object is to carry on business or profession, and I may be also allowed and permitted to make investments. When we come and see the later part of the FEMA provisions, how this particular provision, if LLP authorities do not allow you, how it will become an hindrance. So we'll have to reconcile between an LLP carrying on the business of NBFC or a LLP which is making an investments in the course of its business and trying to comply with the provisions. If we compare LLP with the partnership, the issue is that you have a minimum 2 partners in both the case, whereas in LLP there is no limit to the partners. This is one of the biggest advantage of the LLPs. Whereas in a partnership you can have maximum 20 partners. Is a legal entity we discuss. Registration is compulsory, not compulsory, may have its own common seal, may not have a seal. Name has to be approved by ROC. We'll leave the procedural aspect of it. Only let's deal with the last aspect, being that a minor cannot become a partner of an LLP because minor cannot contract. And under Indian Partnership Act, there is a specific provision which says that a minor can be admitted to the benefits of the partnerships. This provision is missing in LLP Act. Do we friends have to decide whether do we want to make a representation? According to me, no, because at various quarters a reference is made that why don't we go and meet them? According to me, no, because the status of LLP is that of a corporate body. And this is not we should forget, we should have to have always a balance of mind when we deal with the LLP issue is that are we dealing with a partnership or are we dealing with a corporate body? I am dealing with a corporate body, and that's why the issue whether a minor can become a partner into an LLP, the answer is no, and we should accept this particular fact and move ahead with it. Let us compare LLP with the company. Here 2008 Act, 56 Act, ownership and management can be with the same person. That is, say there are 2 partners of LLP and they are the owners of it and they are the designated partners. Then there will be the ownership and management will be the same. Whereas in company it is divorce. Then we can little skip. Only thing is the last one is accounts has to be maintained, can be maintained on cash or mercantile system of accounting. Whereas in the company the accounts are to be maintained in mercantile system of accounting. A small doubt at some corner have been raised is that one side you are saying that the LLP is a corporate body, and you are at the same time you are saying that the accounts are to be maintained in a cash or mercantile system of, or you have this option and the flexibility for the purpose of this. But I believe section 209 for mercantile system of accounting you have to go to the Companies Act. There is no such provision in the LLP Act which prohibits and says that you will have to maintain your books of accounts on a mercantile system of accounting. That provision is there under the Companies Act, and that's why a fair view can be taken that as far as LLP is concerned, you can take a view that you can maintain the accounts on cash or mercantile system of accounting. Second support we get is that LLP is taxed as a partnership firm, and today also I believe a partnership firm has an option to maintain accounts under Income Tax Act on a cash system of accounting. We all chartered accountants are also maintaining accounts on cash system of accounting, though of course we are the professionals, and even some of the business type like commission income or an interest income, possibly a view is possible to take under income tax. So taking all this interpretation together, it is possible to say that the option is available with the LLP. The one part which I have not incorporated here, which struck me a little later, was that in case of a partnership, in case of a private limited company, the maximum number of shareholders could be 50, whereas in case of LLP, there is no limit. You can have an LLP partners with 1,000 partners spread all over India, all over world, and that we'll see later when we see the FEMA provisions. So this is the way, though it's better than even the company in this aspect also. Who could be the partners? Now, there are minimum 2 individuals should be as a partner and who are to be identified as designated partners. Let me just clarify at the outset, the designated partner concept is in LLP, meaning is the persons who are responsible for managing the affairs of the LLP and are responsible for compliance of statutory provisions. In this LLP Act, there is a provision of levying personal penalties on designated partner also. So one who, before he takes up the responsibility of a designated partner, he should be a little careful and should be agile to see that once he takes this responsibility, he fulfills the obligations which are given under the LLP Act 2008. There is no limit we have discussed. The third point is important. Individuals, foreign nationals, foreign companies, Indian companies, foreign LLPs, foreign LLCs can become the partner. The whole arena is open to you now, and you can choose your partner from any of the categories mentioned above. Even there could be an LLP of 3 companies also. There is no difficulty in doing that also if you want to do a tax planning. Of course, this is not the forum for that, but there are various opportunities, in my opinion, now available for the purpose of planning to say that you can have now the LLPs of corporate bodies and try and save a lot of tax, which you can do otherwise not possible. Of course, when the foreign LLPs, LLCs are concerned, foreign nationals, you will have to comply with FEMA regulations, which we will see a little later. And government will be issuing some guidelines for the purpose of foreign LLC and LLPs to become the partner. About designated partner, I just mentioned here, and these are the few procedural part. I think we can little skip over it, that there should at least be 2 minimum designated partners are there. And if the LLP consists of only corporate bodies, then at least 2 corporate bodies will have to nominate 2 individuals who will be the designated partners. So if LLP consists of say 5 limited companies, then 2 of them minimum will have to designate the partner individuals who will be the designated partners. All 5 can be, it is not that there should be only minimum 2 designated partners. Minimum is 2, maximum can as many as all, and all partners also, if they wish, can act as a designated partner. Because if there is an issue of who will take a principal decision in the activity of the LLP, among the partners, if they want each one to be represented fully in the LLP affairs, then each one also can appoint the designated partners. But if in an LLP there are 2 partners, 2 designated partners, one of them retires or dies, then the casual vacancy has to be filled within the statutory time limit. God forbid, if you do not satisfy this particular condition, then all the partners will be deemed to be the designated partners under LLP Act. Mind you, this is a very important provision, because becoming a designated partner is an asset to the extent that you will be able to participate and take part and have the managerial affairs of the LLP, but at the same time there are obligations on you also as a designated partner, which we saw. So if you do not fill up the vacancy within the stipulated time limit, then all of you will be treated as the designated partner. Then admissions and retirement, it is very simple. Any partner can go out, any partner can come in, but this will be all subject to LLP agreement. I'll just deal with that a little later, but issue is that once the LLP agreement is the heart, like memorandum articles is the heart of the company, LLP agreement also is the heart of the LLP. All the terms and conditions on which LLP will work will have to be incorporated into that agreement, and retirement and admission will be subject to that. If the corporate bodies decide and make a clause in an LLP agreement that only corporate bodies will also only become partners, it is possible. You can only make a condition that all those who are staying in Maharashtra can only become partner. All restrictive conditions which the partners want to put into an LLP agreement which is not against any law, then it is possible to do so. So any partner can be admitted or retire. I would only point out at this juncture that please bear in mind the provisions of Income Tax Act at the time of retirement, because section 45 to whatever the sections which are applicable in the judicial pronouncements, where drafting of the retirement deed is a very, very important concept. Because in a partnership, we have seen that wherever there is only a retirement, but it has been termed as a dissolution by the courts and some issues have arisen. Only saving grace is that in case of an LLP, it's a corporate body once again. Again, I am repeating, it is corporate body independent of the partner's interest. It has a perpetual existence, and that's why though we have to take a little care at the time of retirement, but not as much care as we take at the time when a partner is retiring from the Indian Partnership Act. But care definitely will have to be taken as to what is the amount you are giving to him at the time of retirement, and what is the character of that amount in the hands when he is going to receive this money is also critical. And if any asset is distributed at the time of retirement, then definitely some of the provisions of Indian Income Tax Act will also have to be kept in mind. Transfer of economic interest. As said once again that it is a corporate body independent of the partners, the assets waste into the LLP. We have a Malabar Fisheries Supreme Court decision which has said that as far as Indian partnership is concerned, all the properties are held by the partners, and there is an undivided share of each of the partner in each of the property which is held by the partnership firm. This concept may not be applicable in case of an LLP is concerned, because here LLP, the property belongs and is registered in the name of the LLP. Each partner has a right to participate in the profit and the assets to the extent his profit sharing ratio or subject to your LLP agreement. There could be a clause in an LLP agreement which says that your partner share in a profit sharing is say equal, but in profit sharing in the assets is in a particular proportion. In my personal view, this is also possible to do so, because now there is a direct distinction between the property held by LLP and the partner share in the particular LLP. And that's why we have a specific provision in the LLP Act which says that any partner can transfer his full or part economic interest in an LLP to a third party by a document. And this is possible, and that's why you see the Income Tax Act is amended. Section 49 to triple capital A has been introduced from assessment year 2011-12, which defines Section 49, as all of you are aware, deals with the cost of acquisition. So when a partner transfers his share, his right in an LLP, it will trigger capital gains. And what will be the cost of acquisition of that his right in the LLP has to be computed in terms of Section 49 to AAA of the Income Tax Act. This further gives the support to the proposition that a partner can transfer independently his economic interest in an LLP to any third party. But what are the implications of this? The person who buys this economic interest need not become the partner of LLP and may not be recognized as a partner by the remaining partners of the LLP. He will have to be a person who has a right in interest in the LLP qua outside the affairs of the LLP. And this is, we'll have to reconcile to this particular fact. And the assignee will not be able to participate in the affairs of the LLP because he is not a party to the LLP agreement, and he has not been admitted as a partner into the LLP. There is one more concept of partner by holding out. I'll just explain this instead of this is a technical definition I've taken. Suppose in an LLP there are three partners, A, B and C. Mr. X represents himself to be the partner of the LLP and goes out and says that I am also a partner of LLP. The person to whom he represents that he is the partner of the LLP has the option to verify the LLP agreement. But for any reason, he does not do so, and he deals with the LLP in this matter, and suppose he loses the money or he suffers a loss, then the Mr. X in our example, who has represented himself to be the partner of LLP, is called a partner by holding out, and he will be liable to that party who has dealt with this LLP on his representation that he is the partner of the LLP. As far as LLP is concerned, if LLP derives any benefit out of these particular transactions, then probably LLP will also be liable for the losses or the damages which is caused to that third party. This part will have to reconcile with the proposition, general proposition of LLP is that the third party, when he deals with LLP, he deals with his open eyes. He can verify the documents, he can verify the records from ROC, and then he may choose to deal with it. But in a special circumstances where somebody intentionally represents himself to be the partner when he is not so, and then the party suffers a loss, then probably this provision will apply, and he will be entitled to claim from that is from the partner as well as from the LLP. Only from LLP, subject to the LLP has got the benefit out of this particular transaction. First schedule, it is like Table A of Companies Act. If after formation, after you get a registration, within 30 days you have to file the LLP agreement specifying the terms and conditions on which you will be running the business of the LLP. You have an option to say that we will follow first schedule of the LLP Act. That's it. My agreement is of 2 lines. All the partners will say that we will follow Schedule 1. Schedule 1 prescribes the terms and conditions on which the partners will carry on the business. My suggestion is that please read Schedule 1 very, very carefully, because some of the provisions of Schedule 1 are not very, very tax friendly. For example, Schedule 1 says that a partner of an LLP who is supposed to devote his time and energy to the LLP will not be entitled to any remuneration. Now, if you want to have a benefit of Section 40B and remuneration is to be paid to the partners of the LLP, you will have to make a specific provision. Sometimes in a hurry, sometimes in a laziness, sometimes we try to see that, okay, let me just follow first schedule terms and conditions, and automatically it will apply. Yes, as far as LLP is concerned, you will be in a position to carry on business on the terms and conditions of first schedule, but some of the provisions may not be tax friendly. I would not like to spend time on what does it all say. I mean, it's there in the Act, you can see. Only 2 things I will say. If you have formed an LLP agreement and some of the issue you have not covered in that agreement, but that portion is covered in first schedule, then automatically the first schedule will apply. For example, your LLP agreement says, keep silent about the remuneration payable to partner, suppose. Then the first schedule will apply, will say that no partner will ever be able to get the remuneration unless you again amend LLP agreement, because the flexibility in LLP is that you can amend LLP agreement as many times as you choose, and that is why the flexibility is there, and it is between the partners who have to come together and make the amendment in the agreement. So any point which is there in Schedule 1 but not there in your LLP agreement, then it will be deemed that you have accepted the proposition what is in the first schedule of the LLP Act, and you will have to follow that particular stuff. So please be careful to first run through the first schedule, then run through all the provisions which you want to incorporate and see that there is no difference. This is the flow chart of formation of LLP. First, decide the partners and the designated partners. Then obtain DPIN number for the designated partners. Obtain their digital signature. Register on LLP portal. Apply for the name. File the incorporation documents. There are not many. Obtain a certificate and draft the LLP agreement. And this completes your LLP is into existence, is born. It is not like Companies Act where you have to file memorandum and articles before you get a registration certificate. Here registration certificate you get first and then you have to file the LLP agreement. Probably I think the intention of the legislature is that if majority of them try to follow first schedule, they don't have to have much of a document, that LLP agreement, to be filed, and the first schedule provisions will apply. That's why I believe that is the reason why they have made this provision, that they'll give you registration, LLP will be born, comes into existence, and within 30 days time you have to file the LLP agreement. The LLP agreement will set out the partners can execute agreement, which will set out the terms upon which the LLP conducts activity. This agreement can set out the mutual rights and duties of the partners and their relationship with LLP as well as the partners inter se. And the first schedule will apply, which we already dealt with it. Now the next issue is the taxation of the LLP. As all of you are aware, the Finance Bill 2009, that is Finance Act 2009, ultimately made the provision, and the definition of firm has been amended. And okay, let me just deal with it instead of going into a line item, but they are there. As far as Income Tax Act is concerned, LLP will be equal to a partnership firm, long short. So whatever is the law applicable to a partnership firm will apply to an LLP. Each partner of a partnership firm, the share of profit is exempt under 10(2)(a). In case of LLP also, the share of profit from LLP will be exempt in the hands of the partner. Partnership firm, LLP will have to pay tax at maximum 30% of their income. Interest and remuneration can be claimed by LLP as a deduction while computing the taxable income, provided the provisions of section 40B are complied with same force what is applicable to partnership will also apply to LLP. So please ensure that an adequate, proper clause is incorporated in LLP agreement, enabling for payment of remuneration and the interest to the partners, and effective date also, validity also, so that you will get a deduction. In the hands of the partners of LLP, the amount what they will get by way of interest and remuneration will also be taxed under the head business and profession, as in the case of partnership. The distribution of the income by LLP is not subject to dividend distribution tax. This is one of the biggest advantage of the LLP structure vis-a-vis a company, because in a company you earn 100 rupees, you first pay corporate tax, balance 70 rupees you can distribute either by way of a dividend or by way of goes into reserves or buyback of shares. In either event, either you pay dividend distribution tax or you pay capital gain tax on buyback of shares. Whereas in case of an LLP, once the LLP has paid the tax at maximum marginal rate, the surplus can be distributed to the partners without any further levy in the hands. Another advantage is that if a company is a member, as a partner of an LLP, then whatever is his share of profit which will be credited in the P&L account will not be subjected to MAT, because while calculating MAT, there is an exemption that any income which is exempt under section 10 is to be excluded for the purpose of paying MAT. So this is also a great advantage in the hands of a company, of course subject to provisions of 14A, which we'll have to look into independently in the hands of the company, because if this share of profit is exempt under 10(2)(a), then what happens to section 14A for the earning of any expenditure incurred for earning exempt income? That will have to little take care, but that will subject to that. This is, according to me, a very great advantage to a company who is a partner of an LLP. LLP is generally not liable to pay MAT. Certain LLPs, though, are liable to pay MAT on its gross adjusted total income, section 115JC, which is introduced from assessment year 12-13. And adjusted total income means total income as increased by chapter 6A deduction or deduction under 10AA. These are the only two adjustments which you have to make while computing the MAT calculation for LLP. The second distinction between vis-a-vis company is that in a company you pay MAT under 115JB on a book profit, whereas in an LLP you are paying MAT on a taxable income which you compute and not on the book profit. First you compute your normal taxable income, say from profit and loss account, disallowances, exemptions, your gross total income, chapter 6A deduction, total income. And if you have availed, if you are an LLP and if you have availed chapter 6A deduction and the deduction under 10AA, that is SEZ profits, then it will be increased to that extent. So if an LLP has earned any other income, say by of a capital gains or any other business income, there is a fear in the mind of many sectors that on all the profits of the LLP they have to pay the MAT. No, only for those profits which you are eligible to claim deduction, mainly 80IA, 80B, 80IB claims and 10AA claims, only those deductions which you have taken in computation, please add it and then work out, and whichever is the higher of the income for that year, you pay MAT. MAT is payable at 18.5% because no surcharge is payable by LLP because LLP status is equal to partnership. Of course, education and higher education says you have to pay. MAT credit is available, as in a companies we get the MAT credit. In case of retirement and dissolution of LLP, provisions of 45 will have to be looked into because section 45(4) deals with a dissolution of a partnership, and as I explained earlier, that we have to ensure to see that the retirement does not tantamount to a LLP dissolution, though it is specifically provided under LLP Act that retirement will not affect the dissolution of the LLP. Though there is a specific provision, still to be aware from the tax department how they are interpreting the provisions. So we will be a little bit careful at this particular point of time. A designated partner under section 140 of Income Tax Act has to sign the return, and as it's applicable to managing director of a company, if it's not available at that point of time and if you are able to establish, the return can be signed by every other partner. Each partner and LLP is jointly and severally liable for the tax payment of LLP. As section 188A of the Income Tax Act clearly provides that the liability is joint and several as far as the statutory dues are concerned. But we have section 167C in Income Tax Act, which clearly now incorporates and says that if any partner is in a position to establish that non-recovery is not attributable to his gross neglect, misfeasance or breach of duty on his part in relation to the affairs of the LLP, then he will not be responsible. In my opinion, non-designated partners can definitely take a recourse under 167C because they are not a party to an active management of the LLP. They have not participated into the affairs of the management of the LLP. Then for them there will be a more chance to rely upon this particular section to save themselves from the personal liability of the income tax as far as the LLP liabilities are concerned. That does not mean that the designated partners will always be liable. If it can be proved and these conditions are satisfied, probably a view could be taken that they are not personally liable for the dues of the LLP. Conversion of partnership into LLP. Yes, under the LLP Act, the LLP is a corporate body. So you will have to go through the process of converting into a partnership, and there are specific sections, chapters and schedules. Please refer to it. But as far as income tax is concerned, President also raised this issue that whether when a partnership is converted into LLP, whether any tax issue will arise. In my opinion, no, because explanatory memorandum to clauses of Finance Bill 2009 has categorically given an explanation, though there is no specific provision in Income Tax Act, because in my view it is not required, because one form is converted into another form as per the LLP Act, And this explanatory memorandum has clearly stated that there will not be any tax liability when a firm is converted into LLP. So according to me, there should not be any issue when we deal with we professionals of chartered accountant firm, because I believe majority of us will convert ourselves into LLP over a period of time. It's a matter of time then that the accounting firms will, because you will be able to have a more and more international partners. Today, you are not able to rope in many of the foreign entities because the liability is unlimited, even for a professional firm also. But probably now all of us could be in a position to do so, and that part also we will deal little later in this presentation. So converting firm into LLP, I don't see any issue as far as tax is concerned. As far as LLP provisions are concerned, it's very simple. Please comply with all those requirements and you will be able to convert it. The next issue is, can we convert company into LLP? Yes, the answer is yes. Every existing private and public company, except the listed company, can be converted into LLP, and all the assets and liabilities of the existing company will vest into LLP. Please bear it in mind, wording of section 58 of LLP Act. It says that on conversion of a company into LLP, the assets and liability vest into the partnership, into the LLP. It doesn't say it will transfer into LLP. Please just keep at the back of your mind the distinction between these two words, which we'll need in 5 minutes for deciding the very important issue of taxation. So section 58 is very, very important of the LLP Act when it talks about conversion of a company into an LLP. There are two restrictions in conversion of a company into LLP. One is a listed company cannot be converted, and second is if any security interest subsists on the time when you want to convert it, then that also not possible. What do I mean by saying that security interest subsists? Means if a company has taken any secured loan and that secured loan is outstanding as on the date of conversion, then that company, though being a private company or a closely held public limited company, cannot convert into an LLP. You will have to be very, very careful in dealing with this particular provision, because in practical life we have seen one or two instances which I have also narrated a little later, that how the difficulty came at the last minute when we never realized that problem. All the existing shareholders must become the partners of LLP as per LLP Act. I am just now only dealing with the provisions of LLP Act and not with section 47, 13B of Income Tax Act. Please bear it in mind. I will deal with that part little later in next few minutes. Just now, the compliance I am looking at is when a company is to be converted into LLP, all the existing shareholders must become the partners of LLP. Now this is very important, that company which has repaid the loans must ensure that the necessary formalities of Companies Act is complied to remove the charge. We had a live case where we were handling some referral matter where we saw last 3 years balance sheet of that company, there were no secured loans. We asked the management that have you ever borrowed money on that? In lighter mode, they had borrowed money only for 3 months secured loan from a bank, a specific borrowing. The bank was smart, bank created a charge at the time when the loan was granted. They repaid the loan within 3 months. Thereafter, this happened in the 4th year before. Last 3 years balance sheet, no loans outstanding. All the process was completed and the ROC took the objection. They said that there is a security interest subsists in your case. We tried and argued, but we didn't realize that the charge was not removed by the bank, though this SSE had filled up all the forms and handed over to the bank. I'm just showing this a practical, that it is not that there is no loan outstanding on the date of your conversion, but please ensure that there is no charge which is still subsisting in the records of ROC, because so long as that is existing, according to them, there is a security interest created, and that's why they will not give the conversion permission. So I thought as a practical example, what we saw over a period of our practice, I'll share with all of you. And we wasted 1 month, unfortunately, in that period of time. What happens when this is a time when I'm talking, when the ROC Delhi was in charge, there is no personal communication possible with them. You have to send a mail, reply, sometimes they don't reply, you call them helpline, nobody is ready to answer. And this new technology where everything is online sometimes creates so much difficulty when statutory compliance is there. I always believe, and I'm a firm believer, that somebody should answer and should say that what are your problems, these are our objections. And every time you send a mail, they are just saying, looking into it, there is a security interest, you please look into it, we'll not do. But what is your objection? Not on this, on many other occasions where days and months are wasted, we do not exactly know what is the difficulty and what they want us from us. Now at least decentralization has definitely helped, and they are now able to answer and positively try to resolve the issues. And relevant provisions. Now let's look at the tax issues. The most important hurdle in converting company into LLP is the chargeability of capital gains. The government view is that there is a transfer as in terms of section 45(1) of Income Tax Act when the LLP company is converted into LLP. And that's why they have given an exemption under section 47(13)(b) of Income Tax Act. But you know how government is. Every time they give a relief, there are so many provisos and caveats they put into it, and unnecessary. So first of all, if you believe that there is a transfer when a company is converted into LLP, then you will have to satisfy the condition of 47(13)(b) to say that there is no liability for payment of capital gains tax. Now there are 6 conditions. First condition is, I have not listed all the conditions, but the conditions are there in the Act, you can please refer to it. But I have tried to highlight 1 or 2 which is creating problem. The issue whether the conversion of a company into LLP is a transfer or not, I am not dealing that just now. I am now dealing, the head of my topic is reference to section 47(b). So for the time being, I am assuming that it is a transfer. I am assuming, and it is not so according to me. If it is so, then 47(13)(b) conditions are to be satisfied. Now please see the second para, that if you do not satisfy the conditions which are under 47(13)(b), meaning one of the condition is that the partners shareholding in a LLP for the first 5 years should not go below 51%, those partners who are the shareholders of the company. So at any point of time, there could be inter-se change in the profit sharing ratio of the partners who were also a shareholder of a company, but the total shareholder profit sharing ratio cannot go below 51%. And the second clause is that the reserves of the company cannot be distributed to the partners first 3 years of forming the LLP. Now, if you violate any of these 2 conditions, then section 47(a)(4) will apply, and you will be liable to pay capital gains tax in the year in which these conditions are violated. Then please look at one of the conditions of converting of company into LLP is that 3 preceding years from the year in which conversion takes place. Suppose conversion takes place in December 2012. Then 3 preceding years means March 12, March 11 and March 10. In any of these years, your gross receipt, sales or turnover should not exceed 60 lakhs of rupees. So in any of the 3 years, if in 1 year also it exceeds, then exemption of 47(13)(b) will not be available. You will be able to convert that company into LLP as per LLP Act. There are no restriction in LLP Act. But assuming it is a transfer and this condition is not satisfied, you will be levying the capital gains. Now, first of all, my question is, what is the sanctity of the 60 lakhs? I could find only one answer under section 44(ab). We had a turnover of 60 lakhs of rupees. That is now raised to 1 crore. Still, they are stuck with 60 lakhs. Intention is that the small partnership, small companies who are converted into LLP should not be burdened with the liability of capital gain. Does it mean that the large companies should be burdened with the liability of capital gains tax? When you are propagating a particular model for the businessman to follow, and which is a very good model, why should you put these artificial conditions? So that is one first question. Second question is, can these artificial conditions be challenged? Can we look at one or two decisions? Please see the decision in 183 Taxman 209. Under section 80C, the limit for claiming exemption when you make claim 80C, it was not possible because under PPF Act, they were not accepting more than 70,000 rupees. So one advocate from Delhi challenged in a writ petition to the High Court and says that one particular provision of the statute tells me and permits me to make investment up to 1 lakh of rupees. Why not PPF Act be amended and I should be permitted to make further investment up to 1 lakh of rupees? And High Court directed, and now PPF Act is amended. Can somebody make a challenge by saying that under LLP Act there are no conditions stipulated for converting the company into LLP? You are making a distinction between a small and a big company by artificially providing a tax turnover limit of 60 lakhs of rupees. Please give the sanctity or either remove it. I wish somebody will do it some other day. But today the problem is that if you still believe that conversion of company into LLP is a transfer, then you'll have to satisfy with this condition. Now let's proceed further. Now what does that section say? Section says that sales, turnover and gross receipt in the business. The issue is, it should be my business income or should I have these three elements in my business? What do I mean by that? Please look at the fourth line. If a company's business is to own properties and let out, and their rental income is 100 lakhs of rupees, suppose. Take a live example we are facing today. Our argument is that my business receipt in my P&L is more than 60,000 rupees, but for computing taxable income, I am offering this under section 22, I have a nil business income. Do I have to look at the computation part for complying into 4713B, or do I have to look at accounting part for complying provisions of section 4713B? Unfortunately, the language, if you see, it talks about the nature of that receipt. So the receipt should be business in my P&L certified by the auditors, then I am stuck because that my computation doesn't have any bearing. But if my nature of receipt is not the business, probably that answers my next question. That suppose a LLP has interest income more than 60 lakhs of rupees, which is not his business income. But that business, and that's why probably a view could be taken that because accounting wise you are not treating as your business income, but in taxation if I am offering this as a business income to claim some deduction, whether will I get away? If answer to fourth is that you look at only accounting character and the character, don't look at my computation, then even fifth part I should get out of it. So we'll have to mentally reconcile on the facts of each case that what is and how are you going to satisfy the condition of 4713B. Then the next is and most challenging part is that do I say that I forget 4713B, I don't want exemption under 4713B. I care two hoots for this section. According to me, the transfer from the conversion of a company into LLP is not a transfer at all under section 45(4). There is no dissolution of the company, nor there is any chargeability or there is transfer under 45(1), for which please read section 58(4)B, which I just mentioned little time ago, and just for the benefit, what it says is that all tangible, that is when company is converted to NLP, what happens? All tangible, movable, immovable and intangible properties vest in the partnership from or the company, because there the issue is, as the case may be, in all assets so and so liable. Now please compare the wordings of section 58.4 with the sections 565 to 579 of the Companies Act. Under these provisions, any entity can be registered as a company. All of us are fully aware about it. Part 9 is a very popular mode where in past we have converted various firms into companies and registered them as a limited companies. Now if you compare this language of 565, 575, which is on the next slide, second part, section 575 of the companies provide that all properties movable and immovable, including actionable claim belonging to the firm, shall on registration pass on and vest in the company. Section 58.4 has just copied, according to me, the provisions of section 575 of the Companies Act, and the concept is vesting of the assets from the firm from the company to the firm, and there is no transfer. And for this proposition, fortunately, we have a lot of case laws to support it. The first of them is 263 ITR 345 Bombay High Court in the case of Tetspin Textiles. This partnership firm got converted into a company under Part 9 of the Companies Act. The Income Tax Department tried to invoke Section 45.4 first and then Section 45.1 alternate. Bombay High Court has in no uncertain terms have held that in this event, the properties have just vested into the company and there is no transfer by the firm to the company. And I believe ratio of this decision will definitely be applicable to all of us, and there will be definitely some litigation, but view could definitely be taken. I suggest the President that please make a strong representation that instead of getting into litigation when the law is settled, and I'll give you 3-4 more case laws where this particular issue has been dealt and where the courts have clearly held that there is no transfer in this event. One is of Umicore, this is an AR ruling, same issue, whether when Part 9, when firm is converted into company, is there any liability of capital gains? They have said no. 2 more tribunal decisions. And for all those who are present here and who are academically interested, please read this decision, the last, that is Wali Pattabhiram Rao decision, which is in 60 company cases. Very interesting decision. The small facts are like this. One individual lessor gave his land on a lease to one individual lessee. Individual lessee introduced his right in a leased property to a partnership firm. Little later, this partnership firm was registered under Part 9 to a company. The lessor challenged it by saying that you have violated my terms of tenancy, and there is a 2 transfers we have done. When you introduce your right in the lease into a partnership firm, there is a transfer, and when that partnership firm was converted into Part 9 into company, there is another transfer. So twice you have violated the terms, and the Andhra Pradesh High Court has turned down both this proposition and saying that when an individual introduces his right in an asset into a partnership firm, there is no transfer. And that's why Income Tax Act was amended and Section 45.2 was introduced specifically for that. And general proposition also they said that when the firm was converted into company under Part 9, there is no transfer, and they have held that there is no violation of a Tenancy Act. And they have said that there is no violation of Section 5 of Transfer of Property Act. Also, there is no transfer, meaning no even stamp duty is payable on this particular transaction, because the lessor took various objections. And I suggest that this is a very, very interesting decision which each one of you must read to really understand what are the issues which are involved in that. President, I think the way I am going, can I take a little longer time? With the permission of everybody, or should I run fast and finish because some of the issues are there? Next issue is what happens to carry forward business loss and unabsorbed depreciation when the company is converted into LLP. We have section 72A 6A, which says that whenever a company is converted into LLP, the unabsorbed business loss or depreciation can be set off or can be allowed to be carried forward. But the unfortunate part is this section says that this benefit is available provided condition of section 47(13)(b) are satisfied. Now the proposition is that if you do not satisfy condition of 47(13)(b), where are you? Will you still get the carry forward of business loss or unabsorbed depreciation in the hands of the LLP, or you will lose it? My personal view is you will not lose it, because as discussed earlier in last 10 minutes, the event of conversion of company into LLP does not tantamount to transfer, so there is a continuity and existence, and the status is the same, though from a form of a company, the business form is taken into LLP form, all other conditions remain the same. Your shareholders are the partners. I am assuming that you have not violated the other conditions of that. And for that matter, this is the provision, and I again request the President to please deal with this issue, because there is enormous litigation will start with the department. Many of the companies are not able to convert to LLP because of this provision, because they have a carry forward and loss and depreciation. And today the litigation is so expensive and costly and the troublesome, that's why nobody wants to take a chance. So if this provision is to be interpreted in its right spirit, I mean in the words it is mentioned, then you will have to satisfy the condition of 47(13)(b), and then only the carry forward will be permitted. Finance Act 2011 amended 8 sections in Income Tax Act to give effect to the conversion of a company into LLP. The first is section 32(1) proviso, 5th proviso, which says that if during the year, if there is a conversion of a company into LLP, then the total depreciation which is available to a company otherwise on its opening WDV has to be apportioned between the company and the LLP on the number of days basis. Fair enough. Second provision is section 35 DDA, which says that amortization of the voluntary retirement scheme, which is eligible, whatever is the balance left in the hands of the company, which is to be apportioned over a period of time, and that period is unexpired, the LLP will be in a position to take it. Then 43(1) actual cost, the cost in the hands of the company will be cost in the hands of the LLP. Then 43(6) the written down value in the hands of the company will be the written down value in the hands of the LLP. Section 49(1)(3) the cost of previous owner, that 43(1) was actual cost, sorry, the item 3 is, I missed it, that where 35AD deduction is allowed, meaning there are so many businesses where 100% of the capital expenditure is also allowed while computing the taxable income. So if the company has availed 35AD benefit, then the cost of that asset under section 43(1) in the hands of the LLP will be nil. Then this serial number 5 is 49(1)(3) cost to the previous owner. That is the cost in the hands of LLP will be cost in the hands of the company. 49(2)(a) we dealt with little earlier, that if a partner of an LLP transfers his right in an economic interest in an LLP, how do you compute the cost that is under 49(2)(a). Section 72A 6A, just now we saw the carry forward of depreciation, and 115 JJA7, that carry forward met credit of a company will not be allowed in the hands of the LLP. These are the 8 provisions, but again the underlying tone of each and every provision, and there is a specific condition that all this is possible only when you satisfy condition of 47(13)(b). Meaning the written down value in the hands of the company will be written down value in the hands of the LLP only when you are satisfying the condition of 47(13)(b). Now take a case that an aggressive view is taken, and on basis of our analysis and judicial pronouncement of even Bombay High Court, somebody takes a view that it is not a transfer at all. and my turnover is more than 60 lakhs of rupees, I do not want a benefit of 4713B, and still I want to convert it. What will happen to him qua these 8 sections are concerned? Of course, last is that no MAT credit available, fair enough. I mean, we have no dispute, is a legislation intention, and you have to abide by it. But 1 to 7, what will happen? I think there will be a litigation with the department. The stand of the SSE will be that irrespective of exemption, because I have converted, I should be given all this, because the company does not exist. Now that return down value, where it will go? If you do not want to follow return down value, give me the cost of the at which I have purchased this asset. Now let us take a little digress for a minute, that if this is not possible, then what happens in the books of LLP? What will be the accounting entry? Just this is a transition. So all assets will be taken at a book value, all liabilities will be taken at a book value. The difference between the share capital and the reserves will be credited to the partner's account depending upon the terms of the partnership, whether it is a current account or a capital account, whatever you want to decide. But naturally, it will be the net worth of the partners will be assets minus liabilities. Suppose the department turns around and says that we will not give you benefit of 1 to 7 sections because you are not satisfied 4713B condition. Can we say that forget it, we don't want that? What is my cost of acquisition of all these assets is the cost which I have recorded in my books of accounts, and what is my liability is the liability I have recorded. So you please allow me the depreciation not on the WDV as per Income Tax Act, but on the WDV as per my books of accounts. This alternate argument can be put. 35AD, though company has already claimed deduction, the assets still exist in the hands of the company. So if you do not want to give me this benefit, I will merrily claim further depreciation on that value of that capital asset, which is already 100% deduction I have claimed. If department wants to put the pendulum swing at one end, we can definitely swing it at the other end, start claiming this, and probably somewhere a middle we find out. But the issue is, who will bail the cat? Who is going to start this? Don't worry, friend, there are companies who have converted and they have started preparing themselves, and 12-13 returns are filed, and let's see what they are going to do this time, where 4713B conditions are not satisfied and a claim has been made with the proper appropriate disclosure notes in the return, and we'll see what happens to this matter. But I thought it is very interesting subject, so it should be brought to the notice, and I think this also should be a part of representation, so that at least in this finance bill, if some amendment comes, it will be a great boost to the LLP. Can LLP be converted back to company or reverse? You converted company to LLP, you got tired of litigation, you did everything. You want to turn around and say, no, I want to go back to my company. Or a new LLP form which we want to convert into company. Possibly one route, I think, why is that if you want to go public, then you have no option but to go through a company route, because LLP cannot go public. And that's why suppose a very successful LLP is there who has large reserves with them and they want to go public, then definitely they'll have to convert themselves into a company first and then a listed company. Under LLP Act, there is no provision of conversion. Frequent FAQs on LLP says, the second point, the FAQs on LLP clarifies that enabling provision will be required to be made in the Companies Act for such conversion. My proposition is, why not under section 565 to 575 what we saw, where under Companies Act part 9 clearly says that any legal entity can register themselves into a company by following the procedure in part 9 of the Companies Act. There is no restriction, in my opinion, till today, that why not an LLP be converted into company. Only one hitch, if at all it can come, is somebody will argue against us by saying that, look, you yourself are admitting that LLP is a corporate body. Now we want to convert one corporate body into another corporate body. That's why it is not possible. I see the force in this argument also, but because what 565 to 575 of the Companies Act says that any other legal entity can register itself as a company under part 9. But is a corporate body can register itself as a company? I have my own, because as I said in the beginning, these are all the new virgin areas. We'll have to jump into it, find a solution or find some proper answer to this. Today there is no clarity into this aspect of it, and it is, I have not known any LLP which is converted into company. To the best of in my practice, I have not come to know. But we are in the process of taking one step into this direction and making an application to ROC next week for doing this, and let us see what is the result of that. Chartered accountants in practice. As I said in the beginning, is really an interesting issue for all of us, those who are practicing, and I believe each one of you who are present here are almost in practice. So, can form new LLP or convert existing partnership into LLP. Section 2.2 of the Chartered Accountants Act 1949 defines a member in practice. A member can be practiced in partnership with other chartered accountants in practice. The word partnership is not defined under the Chartered Accountants Act. So, Government of India, Ministry of Corporate Affairs have issued a circular number 10 dated so and so, clarifying that the word partnership in section 2.2 will include LLP, where other partners of the LLP are individuals. So, this one hurdle is over. So, you could practice today individually, or you can practice in partnership with other who is eligible to practice. The word partnership was not defined, and now they have made this amendment. Government of India has also clarified that the effective date is so and so. Then section 226(3)(a), which was also coming in our way, which said that a body corporate will not qualify as an appointment as a statutory auditors of the company. LLP being a body corporate would not have qualified to become an auditors of the company. The Ministry of Corporate Affairs have issued a clarification, while general circular number so and so and so, that the chartered accountants will not be treated as body corporate for the limited purpose of section 226. So if you form a new LLP today, in my opinion, the company can immediately appoint you as the auditors, no difficulty at all, because all the hurdles have, according to me, has been overcome. The provisions of Chartered Accountant Act 49, Chartered Accountants Regulations and Code of Ethics issued by ICAI shall be applicable. Here in this particular area, some members have expressed a doubt that whether Companies Act is amended, we can understand LLP Act permits you to do so, but whether the Code of Conduct and the rules applicable to we Chartered Accountants are definitely still applies to LLP and partners of LLP. I cannot make much comment on that, and I look forward for a support or help from the members of the Central Council if anybody is here. But assuming that it is so a new partnership firm, new LLP can definitely be formed. Only difficulty is in case of an existing firm, because section 224 of the Companies Act, suppose a CA firm is appointed as a statutory auditor of a company in September 2012. They convert themselves into an LLP in December 2012. So that partnership firm will cease to exist and it will deem to be dissolved, and new legal corporate entity has come into existence. So under Companies Act, under section 224, will it term be a deemed casual vacancy? And the company will have to follow the process appointing the LLP. This aspect, though representations have been made to Corporate Ministry of Affairs, there is no answer from them. Company law board is also not answering, and no professional firm is ready to take the risk, because to lose the appointment as the auditor. So they all have withheld their conversion, though names are approved in many of the CM firms, but they are not converting, they are waiting for this amendment to come or the clarification to come. Then the statutory compliance I would like to run through, because there are one or two more interesting issues are there. You can just read it, how much you have to follow, you have to get the accounts audited, file the accounts. Then there is an arrangement of compromise. There could be a compromise between the LLP and the creditors, or between the LLP and the partners, merger and demerger. This is very interesting. And last part I would just like to see. It is always of belief of the we professionals that under section 391 to 94 of a Companies Act, mergers can only take place between the limited companies or the corporate bodies, which according to me was not correct. Forget LLP, I am not talking just now, I am digressing for a minute that can an application be made to the Bombay High Court in a Bombay where there are 3 transferors, out of the 2 are companies, one is a partnership firm registered under section 1932 and the transferee is a company in a scheme of merger and amalgamation. The first impression of everybody is that no, how can it be? The section 391 to 394 applies only to companies. An answer to that is not correct. We have a live case in Himachal Pradesh High Court in the case of JHS Stuttgart Laboratories Limited, where there were 3 transferors and one of them was a partnership firm who transferred their assets and liabilities to a transferee in a scheme of merger, and the transferee allotted shares to the shareholders of the transferor company. Here they allotted the shares to the partners of the partnership firm. If this is the precedent available and there is no prohibition, the answer to my third query is whether LLP can be merged with a corporate body under a scheme of merger. My answer is yes, it is possible to do so, and you can definitely do a scheme of merger. Dissolution of LLP, as we have discussed, just take care the last point I just want to highlight. Please bear it in mind the decision of ALF Form 189 ITR 285, very dangerous decision. The Supreme Court has said that of a firm who has a stock in trade at the end of the date, on the date of the dissolution, and if there is a dissolution, you will have to value that stock at a market value and pay the tax as business income in the hands of the firm. In case of a realty company, we have seen sometimes without realizing when there are 2 partners and one of them dies and that realty company has a huge stock of the real estate in a city of Bombay, sometimes the ignorance of the tax officials, you get away with it. But if a smart guy comes, he'll make your life miserable, because that's why forming of a partnership deed and forming of a LLP agreement is also very critical. Sometimes the trend among the businessmen are that last year's partnership deed is available, or on a Google they will go, take one specimen, just copy it, make change in the name and then finalize it, without realizing that in an event of such happens, where there are, imagine 2 partners and one of them dies all of a sudden, and the company has a stock of crores of rupees. What will happen to that firm? According to me, they will be in a big trouble if ALA form is applied to them. So whenever you also frame this LLP dissolution, please be careful to see that this is complied with. Then there is winding up. There are winding up rules are there. You can before 5 minutes, President. Sure. There is inbound and outbound investments. Now LLP is also can be an entity in which the inbound investment is possible. Only you have to have the permission, prior approval of the appropriate authority, and that is also possible in an area where 100% FDI is permitted. So suppose an insurance sector where inbound investment is permitted only to the extent of 26%, which is going to be raised to 49% if all this drama in Rajya Sabha, Lok Sabha is over. Then, but according to me, those are not the sectors where LLP will be permitted, because it is very clearly said that where there is 100%, see the item serial number 5th, where FDI is only allowed through government approval in the route only when FDI is permitted in a sector, and FDI is allowed through an automatic route, and there are FDI, and there also no conditions should be attached. Like in a realty sector, there is a provision that there should be the minimum area of say 50,000 square meter, or the project size should be of particular limit. All this still RBI and government has started slowly opening up the area of the inbound investment, but there are a lot of conditions which needs to be followed. The foreign institutional investors and foreign venture capital investors cannot make investments in LLP. This is a direct prohibition because they feel that they have been given other leverage to make the investments into India. LLPs are not permitted to avail external commercial borrowing. Then only company registered in India under the provisions of Companies Act can nominate a designated partner in LLP having FDI. No entity such as foreign LLP or trust can nominate a designated partner. So suppose you have in your LLP two foreign companies or foreign LLPs as your partners, they will not be able to nominate a designated partner because the condition is that in that LLP with FDI, the person must satisfy both the conditions, that is condition of a resident in India as per section 7.1 of LLP Act plus section 2.5 of FEMA Act, which says that he should reside in India for minimum 182 days. Then I'll just deal with outbound investments. Today, LLP can make investments outside up to 4 times its net worth, only subject to permission for RBI. It is not falling under an entity which is under automatic route. So you'll have to go to RBI and take the prior approval of so-and-so. And existing companies having made outbound, only my question is that whether LLP, when there is no guidelines, unfortunately, we are looking for the guidelines. Will they put a condition that you must earn foreign exchange so that you can make investment outside India, because our foreign exchange condition is not that good. All of you are fully aware. We are all awaiting for the guidelines. No guidelines is so far available. And the company which has made outbound investment under automatic route, can you convert into LLP? The answer is yes, but definitely you will have to go through RBI first, take their approval and then do it, because what will happen is, suppose your company has made investment into a joint venture company who is in a manufacturing company, then fine. But suppose you make an investment into a joint venture company which has made downstream investment into a manufacturing company, and that is only an investment company. Whether RBI will allow or not, we'll have to just see. Lot of applications or queries have gone to RBI. We are all awaiting their reply on that matter. And last is the stamp duty implication is also a hurdle in converting a company into LLP. The issue is that is the stamp duty applicable when company is converted into LLP when a company owns immovable property? My answer is no, because there is no transfer, there is vesting of the property. The Rouse decision in 60 company cases says that there is no transfer under Transfer of Property Act also. And for all those who are staying in Maharashtra or where Bombay Stamp Act is applicable, please see the definition of conveyance in section 2G of the Bombay Stamp Act. And if I can just read it, 2G, Bombay Stamp Act defines conveyance, means any conveyance on sale, instrument or decree under which the property movable or estate or interest in a movable is transferred to the transferee. Here also they are talking about the word transfer, meaning that there has to be two independent transactions in which from the transferor the assets are transferred to transferee, then only it defines a definition of conveyance, whereas in our understanding it is only vesting, and that's why there is no transfer and probably stamp duty is not applicable. Thank you friends for your patient hearing, and I will try to do best whatever I know to say.
Wait for a couple of minutes. Thank you, Dilip V, for a lucid, learned presentation on LLP. With this, I will just request Kirit Dedia to propose a well-deserved vote of thanks.
Good evening, friends. First of all, two announcements. On the 20th of this December, Thursday, our next meeting is to be taken by Mr. Kishore Karya on the subject of selected tax accounting standards. And friends, on this 30th of this December, there is a sports day organized by Bombay Chartered Accountants Society, where members and students are invited to participate in various competitions like chess, table tennis, badminton and carom. Please encourage your article students and yourself to participate in this program. And now, friends, though the LLP is 3 years and 9 months old legislation, we professionals are reluctant to recommend this form of organization to our clients largely on account of we are not comfortable and not knowing the nitty-gritty of this legislation. Dilip bhai, after listening to your today's exposition on the subject, now we feel we are confident and definitely will start recommending this form of organizations to our clients. On behalf of Bombay Chartered Accountant Society, sir, I propose a very well-deserved vote of thanks to you and request all of you to put your hands together. Thank you very much for your large attendance over here. Thank you very much.